2 annuities and 1 CD. And, at first I said, do I owe taxes on this amount of money? And at first I was told no. And then I received a statement from one of the annuity companies that said that they were going to report the interest to the IRS.
Yes.
So my question is, do I owe taxes on this money or don't I?
Yes.
Yes.
Sorry, Dee.
You didn't ask for more. So, Dee, let's help you. At this point, what happens is the way annuities are taxed is that it's sort of, you can think of it like a certificate deposit that was never taxed on the interest. So whatever amount the relative that you receive these from put in, their capital, their contribution, that's going to be a tax-free return of capital.
Okay.
If you surrender the annuity in a lump sum, you will pay interest. You will pay taxes on all that interest that was accrued above what they had put in.
Okay.
Okay. Now, you do have,
now, am I taxed on their tax rate or my tax rate?
You're taxed on your tax rate. That's right.
Okay.
Now, what happens is you do have one other option that you might want to consider. The IRS doesn't require that you necessarily have to pull this money out all at one time. You can pull it out over a 5-year period. And that's an option that they would have made available to you.
Which also means that you're not going to pay over the 5 years, they're not going to pay taxes on all of the distribution because there's going to be an exclusion ratio in which a portion of the capital, you have a return of your capital, and a portion of the interest which was accrued is going to come out. So that will reduce your tax liability.
Right. So when they wrote you that letter they wrote you, you may have requested what happens if I surrender this, and they gave you that full number, but they do have other options that are available to you. And the cool part is you can get those over the phone, or we'll send you another letter about that. But you do have at least a year before you have to begin to make those distributions.
Okay, well then another question I have, and I guess they are being surrendered because there's other relatives involved and they want their portion. So
Reed is good.
So I guess my question is, can I still invest it in such a way to where my tax liability would be less?
Well, let's ask a question here, Dee.
Are you employed?
Are you working?
No.
Okay. Are you married?
Yes.
Is your spouse working?
No.
Okay, so you're both retired?
Yes.
Then the answer is no.
Oh, well, you could make charitable donations.
Right. I don't think Dee wants to give this money away.
She asked us to lessen the taxes.
Did either of you work at all in any gainful employment whatsoever, or plan on doing so this year?
No.
Okay, because if you did, what you could do is make an IRA contribution.
But you can't.
But I can't. You're right. Okay.
So put them out to work.
Yeah, send them back to work for a week.
Say, take this for the team, honey.
I brought in this delightful inheritance. Now go work for the taxes.
Make them sing for a supper, right?
Yeah.
Okay. That's well, thank you very much. I do appreciate it.
You're very welcome. You have a great day.
That was a great question.
That's a fabulous question. I hope some people had fun. I hope she had fun with it. I mean, we did.
Well, she probably could. Even though it's painful to pay the taxes, it is always nice to receive some cash.
Well, it is, and the nice part here, if you want to say the silver lining is that whomever she inherited from, they didn't pay any taxes as the money was accumulating.
Right, which is one of the issues with those annuities that are.
So let's extrapolate on this for a moment, because we were trying to come up with a solution for Dee, but she wasn't helping us any, right?
Well, some people are in the position where they just have to pay the tax. They're very patriotic.
And if her husband's name was Tweedle, then you would say that's cool, Tweedle and Dee, right? So
I'm sure that's probably what his name is.
Okay, so I'll bet it's Dan.
D and Dan.
D and D, right? Okay, so let's just assume for a moment that Dan
out of control.
Exactly. So let's assume that Dan or Dee, or both, were gainfully employed. One thing we might recommend to them is
a video that we have on our website. It's called Reverse Engineering.
That's right. How to make those taxable distributions into tax-deferred, tax-deductible contributions. That's
right. So depending upon the amount that Dee was receiving, we could.
And let's assume for a moment that between Dan and Dee,
yes,
even though their life may be dandy, they're earning together less than $180,000, which means they would be eligible to make deductible IRA contributions.
Okay, but I thought he was employed.
No, he wasn't.
Well, I thought
I'm just saying,
I thought we changed the
well, I'm agreeing
nature
with you,
of
but
this
I'm just
world.
saying is they're employed,
Okay.
but they're making less than 180, which would make them eligible for a deductible IRA contribution
As well. Okay.
As well.
So we could reduce Dan's
and D's.
But we could Dan is the one being paid here. We could
Right.
reduce Dan's pay by as much of the distribution as much of the inheritance as we could, so he could contribute that to his IRA, his 401k through work, depending upon if he had
up
maxed
to the
out already.
$24,000.
Exactly. So as much as he
And?
could, and he could also make the IRA contribution for the 6,500, assuming they're over 55.
For him and for her.
Exactly, making that 13,000.
That would be dandy.
It would, it would be, but unfortunately, that was not the scenario.
You gotta go with this one.
Just trying to be realistic.
Okay, well let's get on to Bill. Bill, good morning. Welcome to the